All right, hello everybody. Welcome to our webinar, Investment Review, Where We've Been and a Look Ahead. I'm Eric Danielson, the Communications and Client Services Administrator for AFP. We are recording this webinar and we will record future webinars as well. And we will be holding a Q&A session after the webinar is finished. We will not be recording the Q&A session. So in order to make sure everything runs smoothly, we have disabled everyone's videos and muted everyone's mics. So you can feel free to use the chat if you have any questions during the presentation. Otherwise, if you could always hold them to the end for the Q&A. So on the screen, it shows how to use the chat function. You just click where it says chat, pops up with the bubble, and then you can type in anything you need. And if you do have any suggestions or ideas for future webinars, you can put those in the chat as well. Or if you want to reach out to us afterwards, we can take those that way. So with all that being said, I will hand things off to Terry.
Great. Well, thank you, Eric, and welcome to our economic and investment outlook for 2024. I wanted to kind of start out looking at what happened last year, and then we can kind of bring ourselves forward to this year and look at all those lovely predictions and prognostications that are sweeping the newspapers and the headlines today. But when we go back and we look at the fourth quarter of 2023, it was actually November and December where the markets really started moving. And what we saw happening in October is we actually started seeing the Federal Reserve, in essence, pausing, maybe beginning of November. And so when that happened, when there was this sense that the Federal Reserve was going to pause in their interest rate hikes, what started occurring there is the bond yields in anything other than short term started coming down, and that then created some sense of euphoria on the equity side of the market, and the stocks started going up. So we had a great November and a great December. So heading into next slide, Eric. Heading into this next slide, we're kind of looking also here at what happened, not just the fourth quarter, but we're also looking at what happened year to date. And you can see in the fourth quarter, we had all positive numbers other than US commodities. And then if we look year to date, we saw US commodities continuing not to look so great, but long-term US government bonds, and typically these are 30-year bonds, were also in negative territory year to date. And the thing that I find interesting here is if you look at the second asset index category, the S&P 500 index mid-cap, and look at the fourth quarter return of 11.17, and then you look at the year-to-date number of 14.45, you can see clearly that a majority of the return for the whole year was actually made in November and December. And that is a very similar theme if you look down the rest of the different asset categories, except for S&P 500, which is the top category that we see. And we made about half of the return, a little less than half, in just the fourth quarter, whereas a majority of the return, or another part of that return, I should say, was made previously in the year. And much of that was attributed to what they call the Magnificent Seven technology stocks. So we were seeing at that particular point up to November, a fairly narrow driven market. And so what we did see developing in November and December is actually a broadening of the market participation. And that was a really positive move. So we're going to move on, and we're going to look at the things that drive the economy. And I call this the three engines of the economy. And actually it's very somewhat simplified, but maybe gets the point across. We have to kind of go back again and look at where things have been in order to know where we are going into 2024. And as everybody, I'm sure, remembers that in March of 2022, we had an event take place, and immediately the consumer and the business engines were turned off. What occurred then was that the government engine was turned on full throttle, with stimulus being sent out to everybody. And over that period of time, the consumer and the business were somewhat turned off at that particular point until we kind of round the corner on COVID, and the consumers' pent-up demand was in such demand that they were out wanting to buy goods. Businesses were wanting to support that, but unfortunately, with the supply chain issues, they were not able to meet demands as quickly as there was a need for that demand there. So given all of that, what we started seeing then was when the consumer kind of came back into the picture, they were spending madly in the goods section of the economy. That has transferred into more the service sector of the economy, which is really the much larger section of our economy. And businesses are still humming to produce the things that consumers want. The government engine has, in essence, for all practical purposes, been turned off. So that's kind of the backdrop of what we are seeing going into 2024. So I just kind of want to set the stage, and it's kind of a simplistic view, but this is kind of how we kind of see we need an engine going to keep something humming along, and that humming along is really considered what they call a GDP, or gross domestic product. That is the growth engine of the economy. So moving to the next slide, I think a lot of times when people think about what's happening in the economy, we hear a lot about what I refer to as the wall of worries. What are all the things that are such negative things that are concerning us? And clearly the media and the news love to hammer us on a lot of the negativity. So we'll start there. The economy is growing, but it is starting to slow. And what the gross domestic product for the third quarter of 2023 was up 4.9%. It was not anticipated for it to be that strong, but it was. And so we have gotten our first reading yesterday of the fourth quarter of 2023's growth, and it came in at 3.1. Now, they typically have 3 releases, so this is the first release before they kind of dial the number in more consistently. But the expectation was that the economy was growing at 2%. So clearly the market, or I'm sorry, not the market, but the economy is being very resilient as far as where we are at this particular point, and maybe a little bit more zealous than what the Federal Reserve would like to see at this particular point. Rolling recession, soft landing, traditional recession. Right now, the jury's out. Obviously, we did not have a recession in 2023. It was the most viewed not happening recession I think we've ever had. But many economists out there are saying, could we be already experiencing a rolling recession? Are we going to experience a soft landing? And a lot of economists are in that camp this year of saying, yes, that's still in play for this year. A lot of people aren't really thinking we're going to see a traditional recession at this stage. So that's kind of what we're seeing moving into 23 on the economy. The consumer is there, still spending, but they're becoming a bit more cautious. Higher level of debt is starting to show up, and delinquency rates are going up, and they're higher than they were a year ago. Savings rates have been decreasing, and obviously we came out of a period where there were significant savings built up due to the pandemic. I mean, we've gone through a period of time here the last several years that really is very unprecedented, that we've never really been through to this degree. So some of the numbers, we're trying to find some normality in the numbers coming back into the picture here. But the average savings rate over a period of time since 1960 has been about 8.6%. And so we are seeing this kind of decreasing from where we had been before. Wages have grown, but they are falling, meaning that if somebody was going out previously and they said, I'm going to change jobs, they could get a higher income and switch jobs. That has started to stabilize, and that doesn't seem to be happening as much at this particular point, but we have full employment right now, so that's a positive. Looking at inflation and interest rates, our December inflation rate came in at 3.4%, and our November inflation rate was 3.1%. So we popped up a little bit in December, and some of the projections are showing right now that we are running a little bit higher than 3.4%. for January. So we'll have to see how that comes in. But right now, the trajectory has been going down, but we're kind of seeing a popping up here a little bit in inflation. High interest rates and inverted yield curve. We're going to look at the inverted yield curve here in just a minute, but we are still seeing very high interest rates on the short end. And they're maintaining themselves because the Federal Reserve is maintaining those rates right now. Large cap stock valuations. They are elevated at this point relative to what we experienced in November and December. And they've continued to move up a bit here this year. And what has really started taking fold again is those Magnificent Seven tech-oriented stocks. And the market has become a little bit more narrowly driven so far this month. But that's kind of what we're seeing right now. We still have those geopolitical risks out there with Ukraine, China, and we've added Israel to that list too, and that concern in just the whole Middle East region. So that's kind of our worries at this point in time. And the question is, is this the end of the bear market? Well, according to hindsight and economists, the bear market actually bottomed out October 22nd, I believe, of 2022. And so it started June of 2021. So it appears that we are out of the declining market period, and we have started into a bear market or bull market, and this is the second year of a bull market. So are we going to experience a soft landing in 2024? This is kind of the thinking right now for some of the economists that are out there. So let's look at some of the bright spots for 2024, because there are some. Yes, the consumer is still spending, and they've slowed, but they are still spending. The important thing here is that the consumer does make up roughly 70% of gross domestic product, so we kind of want them to keep spending. And we are more in that service area of the spending being much greater than the goods area. So that's one thing that is a positive at this particular point. We do have a strong labor market, and historically we're at very low rates for unemployment. We're around 3.7% right now. Full employment is considered 5%. And so we're still looking very positive in this area. We do not have right now, or we're not experiencing as tight of a labor market, which is also good. We just have a good labor market, a very good labor market, I should say. So it's been very resilient. Inflation is trending down. We are technically in a disinflation environment right now, meaning that we had high inflation and it is coming down. So in June of 2022, we hit the peak of 9.1, and we have been trending down since then. So that's a real positive. The Federal Reserve would like to see inflation at 2%. So that is their objective. Obviously, we're not there right now, but that's their goal that we are to be meeting. The beginning of the interest rate cuts, well, it's possible. Only a few months ago, we were hearing that interest rates were going to begin to be cut in the first quarter, and that there could be 5 different cuts in 2024. Now we are hearing it might begin in the second quarter. We're hearing May, we're hearing June. We're also hearing maybe 3 cuts instead of 5 cuts. And we're also hearing that the cuts may not be as great. They may only be 0.25%. So time will tell how this plays out, but that's kind of what we're hearing at this point. Bottom line, whenever that does happen, there is a positive ripple effect that will happen in the economy. And so there is an anticipation of that. So there's that part that's positive. And then when that does start occurring, it can be provide a positive situation for the markets. The markets have started broadening out. As I mentioned, in November and December, we clearly were seeing mid-cap, small-cap, international, even international fixed income doing much better. So that has all been a very positive sign that we have been seeing versus the narrow lead market that we were seeing earlier in 2023. The second year of the bull market, and we are going to look at a historical analysis of the presidential cycle. Not that it means anything, but it's just one of those things we're throwing in since this is a presidential year of election. Another thing I kind of wanted to show you was the differences between bull markets and bear markets. It is said that bull markets are somewhat like an escalator. They typically move up slower and they are longer in duration and they are stronger than bear markets. A bear market is kind of like taking an elevator. And as you can see by this chart, they can be very short, they can be very steep. And they can just really make people not feel good when we see these bear markets, but they don't last as long as bear markets. And so I think it's important for people to know this and to remember this because there seems to always be so much information around negativity and bad news and horrible bear markets and that kind of thing. And in reality, if you look at this chart, the last real big rise we had in the market, the green in the far right side, was over a 10-year period from about 2010 through 2021. And so that was our bull market over that period of time. Then we had a month of a bear market, went back to a bull market, and then we went back into a bear market since June 2021 through October of 2022. So that's kind of looking at just that bigger picture. And just wanted to throw that out so you could see that. So I'm just going to look at some statistical information that is out there right now. This is looking at GDP. And bottom line, it's an upward trend you can see, and it's moving positive, and it's continuing in that trajectory. You can also see that the consumer is obviously making up a majority of this. We have a little bit of government spending. We have business spending that contributes to this. Inflation, and this is looking at a chart of inflation over the last 50 years. The blue line is really what I'm kind of focused on. It's kind of the headline inflation as far as where things are at and just from a visual standpoint. And if you look at inflation on the far right, we have that blue inflection point of going up. That is when inflation hit 9.1 at the top and is coming down. And this is through probably November, December timeframe of the 3.4% on the inflation rate. And I think what's important to note here is we can look at the 50 years and we can go back and look at a period back in the early 70s when we had another inflationary period. And we had kind of a double top inflation at that point. Now, the causes for inflation this time are very different than the causes for inflation back then. There are a few little similarities, but bottom line, they were for totally different reasons. The inflation impact here that we've experienced recently was due to the pent-up demand, supply demand, not being able to satisfy that. And that just became a breeding ground for inflation to rear its head. Whereas in the 70s, it was created more related to energy and the like. But the thing that I want to point out here is that we learned some things back in the 70s about how to combat inflation, and that was you need to raise interest rates. And so when this happened back in the 70s, and it was really the first time they really had to fight inflation to this degree, they raised interest rates, thought they had conquered or slayed the dragon, so they started lowering interest rates or cutting interest rates. And they had not really slayed that dragon. And so interest rates went straight back up, or inflation went back up. And so they then had to raise interest rates again. So going fast forward to where we are today and knowing that we are just maybe ending the hikes in the interest rates to reduce inflation, I know that the Federal Reserve is watching this very carefully so that they don't experience the same things that we did back in the 70s. So that's all I wanted to say about this chart, but I think it's an important one to recognize. We have experienced 11 hikes since they started back in March of 2022. So we just wanted to show you this chart. It was very fast, it was very steep, it was very aggressive. And we also feel most likely that the Federal Reserve was probably behind when they started doing this. They probably should have started a little bit earlier because inflation was showing signs that it was percolating and getting a little bit out of control. So they, this is hindsight, but they probably should have started a little bit sooner. So here we are, we're sitting at this particular point, and it looks as if it appears that their last rate hike was in July. And then when they had their meeting in October, November timeframe, they made kind of an announcement that they felt that they were kind of done. At least that's kind of what was said at that particular point, if I remember. Interest rate hikes to interest rate cuts. Are we almost there? We think we are there, but again, I think we can get ahead of ourselves, or the market can get ahead of itself in just saying, all right, we're done. Now we're waiting for the cuts to start. And a little concern here is the idea that inflation has popped up a little bit, that the economy is running a little bit stronger than anticipated. The labor markets are doing pretty well. And so could we be getting ahead of our skis on this one a little bit is kind of the question. They may be cutting in second quarter, but again, they've also said, the Federal Reserve, higher for longer. So they backed off a little bit from that, I think, in one of their recent comments. But they're definitely watching the numbers to determine when they are going to start cutting, and they don't want to start cutting too soon and have the same situation that occurred back in the 70s happen again. I mentioned the yield curve earlier. The yield curve is something that most economists do watch to see where things are at. The bottom line here, the December 31, 2021 line chart, is not necessarily normal, but it's more normal than where we are right now. And what I mean by normal is that the short end of the yield curve typically is lower than the longer end of the yield curve. So to make that bottom line normal, we would really actually have to see 30-year maturities higher than we're seeing the 20-year, much more higher than what we're seeing here. So that's just giving you an idea, though. It was closer to normal. And where we are today, you can see January 23rd, the blue line at the top is showing us that we are in an inverted yield curve, meaning that short-term rates are yielding more than the longer-term rate. And the whole point here is that if you are going out in maturity, you should be expected to be compensated for a higher rate of return for taking on greater risk, taking on greater time. And so that is not in play right now. We've never really had an inverted yield curve and not had some form of a recession or a soft landing. So that is why this is kind of, people are hanging their hat on, we need to see this change before we can really say that, we're going to experience a soft landing or the like. So that's why I think that question is still out there, because we are still seeing this at play. Doesn't always, I mean, again, history typically will say that we have to go back to a normal yield curve. Maybe this time is different, but that's kind of what we're seeing. And the other thing that we are experiencing right now is you can see that the yield curve has steepened, and actually it has steepened a bit from the end of 2023. So that's not a positive sign, but it's just something that we're watching. Labor market. Just simply want to mention that things are good here. We're seeing very positive picture in the labor market. One thing that we look at, and a lot of times you'll hear about unemployment, and you'll hear the number, well, it's 3.7% right now, but that's a lagging indicator. And so what we're trying to look at is what the coincident indicator is, which are typically payroll numbers. And another one is looking at the leading indicator, which is the unemployment claims data. And so that is kind of coming into play in this heat map on the very bottom, where we see green at the very top. And that's a positive sign. So again, there's some mixed messages here, but in general, on balance, they're looking pretty positive. S&P 500 and the history of past presidential cycles. We are in a presidential election year. I think everybody's aware of that. And so this is a chart that's put together by CFRA, and it's just the history. So not that history is going to repeat itself, but if we look at the presidential cycle, year 1, 2, 3, 4, typically the second year of a presidential cycle is the worst. But if we look at the fourth year, which is where we are right now, and we look at the first quarter, it's saying the average return has been 0.7. Then we can see what the second, third, fourth quarter has done, and that the year is typically positive. And it doesn't matter, Republican, Democrat, it doesn't matter who gets in. This is just in general what the data presents us. So the sense is this should be a positive year. Number one, it's the second year of a bull market. Typically it's positive. It's usually the third year of a bull market that might have some adjustments. And then, you know, again, we're looking at the fourth year of the presidential cycle. So I just wanted to point that out to you so you can kind of at least see that, kind of keep that quiver in your thinking, that it may not be bad. However, we do know, given this, that we should be experiencing a much more volatile year this year than we did last year. Last year, we really didn't have a lot of volatility. This year, we're expecting that to be there. So positioning for 2024, looking at your portfolio, should you be doing anything different this year? Being in the second year of a bull market, the thoughts are, again, maybe being a more positive year. We just don't want to panic because we are going to be hit with some news that we are not expecting. It seems to always happen. So we just don't know what that news is going to be. And the other thing is, given the expectations that interest rates are going to come down, giving the expectation that inflation is coming down, if it doesn't happen in the manner in which the markets are expecting it to happen, that then kind of creates a volatile situation. So we could have some pullbacks here. We could have a correction. A pullback typically is 5 to 10%. A correction is typically somewhere between 10 to 20% decline in the market. Anything over that is considered a bear market. So we're not expecting that this year, but we could have some of that volatility in our picture. So the takeaways, looking at the portfolio and kind of keeping our eye on the big picture, is that volatility. We're expecting it. We're expecting some turbulence along the way here, and with the decline in interest rates, and we are also seeing some opportunities though. So usually when we see declining interest rates, we will also see that we can step out a little bit farther on the yield curve for fixed income. Instead of being very short term, which we have been for many, many years, we've already started stepping out a little bit to pick up some return down the road, and also putting in laddered bond portfolios to help cement in essence, kind of that rate of return over the next several years if we can. Another thing that presents a positive to interest rates declining is typically we have mid-cap, small-cap performing better, domestic stocks. And then we also will see real estate doing a little bit better. Real estate has been actually doing very well, and I think a lot of people think it hasn't, but looking at the charts, we are seeing good numbers there. So that typically is an area that also does a little bit better. And obviously what you saw, commodities don't do so grand, and they may not do as well in a declining interest rate environment. So we want to come back and we want to make sure that overall our asset allocation, our number one decision is where it needs to be. If we are a growth investor or growth in an income investor, or aggressive growth or an income investor, we just want to make sure that our asset allocation between cash, bonds, and equities is where we want it to be at this point. We also want to look at the security selection and the placement of securities that we are in. So for instance, there are some things that we would hold in a taxable account, we would not hold in a tax-deferred account for tax purposes. So that's the placement of a security sometimes becomes an important component of looking at one's portfolio if they have an taxable investment portfolio. The other thing we want to look at is your security selection And over the years, the last several years, passive has really been where it's at. And an active manager portfolio has not added as much positive move, anything greater than a passive position. And a passive position is typically replicating an index out there, whether it's a Russell index or it's the S&P index or MSLC an index. It's replicating an index that is being tracked out there. So the one thing I do want to mention here is this year they're saying they feel as if active managers may do better than passive. And I will say there are efficiencies in the market that many times passive, and their expenses are much lower, might just be the better place to be, where around the fringes is where we typically will position things in more of an active manager or manage way. So, that's just kind of looking at how are you investing and what you are investing in. And passive typically has much lower internal expenses too. So passing on the return to you, whereas active is always going to have a little bit higher internal expenses just because of their structure. So that's another thing that we need to take into consideration. But when we're looking at passive, we also have to be mindful about the indexes because they are not all the same. And last year was a really good example of how this was so very different. If you took the Russell index, which I believe the Russell is rebalanced in June, and you take S&P indexes, which get rebalanced in December. Last year, what happened in December 2020, I should say 22, is that in the large growth area, the S&P index that represents that area and the Russell had very different rates of returns throughout the year. And the reason was that the S&P got rebalanced in December 2022. And when that happened, it will rebalance with what they are seeing as the good earnings growth area. And going into December 2022, what was outperforming at that point was energy and healthcare. And so the 8 large technology stocks all of a sudden became 1 in the S&P, whereas the Russell continued to have those 8 beyond the magnificent 7. And so the return difference between these two was a difference of 25% at different points in time last year. So you just need to make sure that you're taking all this into consideration when you're looking at that. That's something that we take into consideration. And so we also want to make sure that we're the diversification in indexes is out there as much as just being in one to represent one area. So I just wanted to kind of point that out. I think also the markets move over a period of time. Obviously, this is a chart of stocks, bonds, bills, and inflation. It's an Ibbotson chart going back to 1926 through 1922. They haven't come out with the 23 yet. And this is just really showing over a long time, stocks do go up, bonds go up, inflation has gone up a bit, but stocks, small cap, large cap, clearly have a higher rate of return than what we get in bonds and in shorter term securities, treasury bills and the like. And so we know we have these periods up and down, but if we can kind of just stay true to the fact that we have this upward trend and we can recognize that is there, that's really the key point here that I wanted to make. There are a lot of things we can invest in. If you take any color here and look at an asset class, rate of return, year by year, you can see that it zigs and zags all over the place, one year to the next. So the point of this chart is to ride through the middle if you can, because it helps to reduce the volatility of an overall portfolio and not be so loaded up in one particular area that's going to give you a lot of volatility in your overall picture. So the key here is just making sure that we have good diversification in our portfolio, which will help reduce the volatility that we might be experiencing. And time, diversification, and volatility are what we're staring at every year. So this is a bar chart looking at a 1-year hold on the left side of 100% stocks or 100% bonds, the blue line, or gray being a 50-50 portfolio. And I can say every year we are staring at the probability that we can have as good of a return in stocks of 47% or as poor of a return of 39%. We can get really fixated on that 1-year holding period. And clearly this year we're looking at it again. But if we're investing over time, we recognize also that we can reduce the volatility in portfolios over a 5, 10, maybe a 20-year holding period. And we can see the reduction in that volatility and seeing a more consistent rate of return coming into the portfolios. And that really is the whole point behind investing, because we know we need time and we need diversification in order to keep volatility and risk in check. So, new adventures awaiting us in 2024. Having just a sense of understanding maybe what we know right now, although I know it's going to change, just helps us maybe to make better decisions as we move into this new year. And I hope this has been helpful. And I wish you all a good, happy new year. This is the end of our program. So if you have any questions, feel free to let us know. Be happy to take them.